And so the three questions or three topics that we had prepared today that we've been hearing a lot about from clients is investing in gold, yield and interest rates on their cash balances, your bank savings accounts or any kind of bank CDs, where to find the best return on that today. And then mortgage refinancing. Mortgage rates are still at close to all-time lows, and how to begin to decide whether or not it's worth it to refinance. Our first question we'll get into is the investing in gold, which if you've been watching any financial news recently, you might know it has recently set an all-time high, just over $2,000 an ounce. And so, of course, this has attracted a lot of attention. Just in the last 4 months, the largest funds, the mutual funds and ETFs that investors like us can buy in that invest gold have attracted about $40 billion in investments just in the last few months. And there's one fund in particular that has gotten the bulk of that 40 billion. There's a lot more smaller ones, and so the total number is a lot higher. But if the idea of investing in gold has recently crossed your mind, you're certainly not alone today. And what I think is really interesting about gold is its history. 2,000 years before the first stock or bond was ever bought or sold, people were already trading gold. And because of that, it's one of the assets that we have the most history, the most data on. And the one thing that's obvious when you look back at gold's long history is its price stability. We know from some records, even back in ancient Rome, that Roman senators would pay 1 ounce of gold to get all their formal attire, their togas and their shoes and their belts. And that 1 ounce of gold would be worth about $2,000 today. And it's not a stretch to imagine, our politicians today in DC spending about $2,000 on their suit, their ties, their shoes, and other accessories to fit in there. And so over 1,000-year periods, gold certainly has done a good job in protecting your money from inflation and currency changes. And that's often one of its most commonly cited benefits, is that it's a safe store of value. But the problem with that is, while the stability does hold for very long periods of time, like 1,000 years, it does not hold for shorter periods that you and I are saving for. Believe it or not, over the last 20 years, the price of gold has been more volatile than the general stock market. And gold has had some very large declines that make it tough to say that it will be a safe store of value for your money over short or even intermediate timeframes. Shown here are some 5-year periods over the last 40 years, along with how the price of gold performed and the corresponding inflation, since a lot of times gold is touted as, kind of an inflation-protected asset. And as you can see, even with the higher inflation of the early 80s, gold fell sharp. This was right after its peak in 1981, so we're cherry picking a little bit, but still certainly not a safe store of value when it can fall 50% in just a few years. This is not to say gold is a bad investment just because it has had these volatile moves. The stock market's had several large declines over the last 40 years too, but most people don't think of the stock market the same way as they do gold. They think of gold as something that will protect their money first and foremost, and that has certainly not been happening, at least since the end of Bretton Woods in the last 50 years or so. And just to put some of the numbers we looked at in chart form, this is a chart of the price of gold on an inflation-adjusted basis over the last 45 years or so. And just to give you a sense of the very long periods of time that gold can take to recover from various price peaks. It is still yet to technically reach a new inflation-adjusted high from its previous peak in 1980. So that's a 40-year period where you're still underwater, on your investments. And even if you invested in the stock market at the high in 1929, right before the Great Depression, and never reinvested dividends or any interest, you were still only underwater for about 24 years. So gold taking 40 years to recover from the last, kind of bubble that we saw should be a warning that if you're purchasing gold thinking that it will protect your investment for the next decade or two, history says that's not necessarily the case. And I want to end our quick discussion on gold with some alternatives that we believe do a few things better than gold. If you're looking for a safe store of value, it's really hard to beat a short-term treasury bond. It's boring, and a lot of people worry about what happens if, the dollar is weakened or the US government has too much debt. But if those concerns do take hold, interest rates will rise, there'll be more risk, and your return in treasury bonds will therefore be increased. And a lot of these are very short-term instruments, and so they're very liquid, very easy to sell if it does look like we're on kind of a big change with how the US government operates or something. These of course have not produced as high of returns as gold, but they've also avoided the large declines in value like gold has had as well. A very bad year for a short-term treasury fund would be a decline of a couple percent, and that's relatively rare. There's some other benefits as well. Treasuries can be invested in very cheaply, about 90% less in fees than a lot of the gold funds that exist today. And they can be bought and sold very easily too, unlike gold where, if you're buying actual physical gold, you're going to have to pay a markup from a dealer. When you want to sell it, they're going to offer you, slightly below market value. And that can be a big spread, 5 to 10% on each side of the transaction, at least. And lastly, if you want an investment that has higher return potential, but could be more volatile than treasury bonds, we like to remind people that an investment in a very broad-based stock fund, like we use for a lot of you at Schwab, has a decent amount of money allocated to these, hard materials like gold or copper or silver, but also oil and farm and agriculture, and the companies that produce those hard assets and commodities that behave a lot like gold. And I think very few people want to move a large portion of their net worth into gold or any of these commodities. So most are always just thinking that they want to have a few percent on the side. And it's important to know that because we use these very diversified stock funds, you already have that. You have about 10 to 12% of your money in these companies that just deal with the hard assets like gold and other commodities. All right, changing topics now. Under our next topic, we've been getting asked a lot about where someone should keep their cash. Everyone should have an emergency fund available, and a lot of people like the security that a large balance in your savings account can provide. But of course, it's hard to see that money sitting there, and especially today, earning about nothing. And so here's a few charts just showing what you already know. Over the last few years, especially, rates have dropped off a cliff. On the left side is a chart of short-term treasury bond rates, and even just a year and a half ago, you were getting over 2%, which also meant that a lot of money market funds were offering rates around there, and banks on their savings accounts might have been as well. Today, that rate is effectively zero, and why you're seeing effectively no yield for bank savings accounts or even money market accounts now have really dropped off. And on the right side is bank CD rates. Again, another really popular investment for savings. And we've just seen the slow and steady decline, especially in longer term CDs now, where even the dark blue line on this chart is a 5-year CD rate. And this data is actually a couple months old in this chart, and even now it's below about 0.5% for a 5-year CD. It's pretty wild. And I think this is hardest for those who are retiring today, who have experienced the really high rates in the 1980s and even the 1990s. Your experience in those times makes higher rates seem more normal, and today's low rates especially painful. But when we look at 150 years of history, it comes as a surprise to many that we're actually closer to normal than you might think we are. This is a 150-year chart of the US 10-year treasury bond yields. And no doubt we are low now. We're at record lows for interest rates. But I thought this put it in the context of how more out of ordinary the 1980s were, as opposed to how out of normal what we think of as maybe a 3% rate is. In fact, the yield on the 10-year Treasury has been below 4% more often in history than it has been above 4%. But if most of your working life was in the 70s and 80s and 90s, that's certainly not your experience. And then there's another variable in all of this as well, and that's inflation. Yes, you got 10% on a savings account in 1980, but inflation was also in double digits at the time too. And in fact, even with the high interest rates of the 1980s, you had worse real or after inflation returns than you have even today. And again, recent history has skewed our expectations of a higher return on cash as being normal. But the early 2000s was actually more of an anomaly than it was, the normal. Over the last 150-year period, like that chart we just looked at on the last slide, average real returns on cash have been closer to 1%, and certainly above where they are today a little bit, but again, not that far off, and average is well below what we saw in the 90s and early 2000s that we might think of as normal today, but they really aren't. And so I wanted to show this info to help rein in some expectations on maybe what interest rates should be or what we think they should be, or at least what they have been in average over history. And so where should you park your cash? Well, today's rates are low. There are a few good places we think that are better than others, and we think there are certainly some types investments to perhaps more importantly avoid as well that we'll cover on the next slide. Some options for today: money markets have the advantage of investing in very short-term instruments. These are like 30-day loans that companies or even the government takes. And because of that, historically, money markets respond to rises in interest rates much faster than some other investments. And so while yields in money markets are very low today, if interest rates rise, you stand ready to, almost immediately benefit with that with cash in a money market. Whereas a bank CD, you might have to stretch to, a 5-year bank CD today to get just some kind of return. And in that situation, you're locked into a low rate for a long period of time. Online banks are also offering competitive checking and savings account rates, usually with interest rates between 0.75% and 1% today for what we see on a lot of them. Online banking is much easier today than it was even 5 years ago. Of course, this is not a good option if you like the idea of having a branch down the street from you. But also offering high checkings and savings interest rates is sort of a game with all of these financial banks to attract new customers. It's a lot of short-term specials that tend not to stick. And a lot of banks that we saw offering higher interest rates just a year or two ago have lowered their rates down now, hoping that, now that you moved all your accounts there, set up automatic withdrawals and deposits, you're going to stick. And so if you go the route of going with online banks, be ready to, be open with, chasing these higher yields that are offered all around if that's something that's really important to you. And lastly, there's an option that I think is interesting with savings bonds today, and I bonds in particular. I bonds are a little bit different than those orange EE series savings bonds you might remember, might have given grandchildren or had yourself when you were younger. I bonds have a couple different components to their return. An inflation component that's guaranteed to keep up with CPI, so your purchasing power of your savings never goes down. And then there's a fixed rate also that stays constant for the life of the bond. And today they return just over 1%. Nothing astonishing, but again, it's an amount that's guaranteed to keep up with inflation, has a little bit higher returns than we see a lot of places today. And because it's a government bond, it's guaranteed, by the government. And so technically no default risk there either, which even money markets today, are allowed to break the buck, they call it, or go below $1 a share. And so I won't spend a lot more time talking about these today. If you do have a lot of cash on the side, for any reason that you're saving and want to learn more about these options, just let us know, and we're happy to kind of walk you through these some more. Before we go on to the next topic, I wanted to be sure to mention a few options that we think are very bad decisions today, but are attracting a lot of attention from investors because of the higher yields that they offer. First is long-term bond funds, and today particularly municipal bond funds. We've seen on a number of occasions from prospects that bring these funds to us that they have, and they're attracted to them because they're yielding around 3 or 4% today, which seems very good relative to the other options we were just talking about. But there's a lot of risk with these, and primarily they're very sensitive to interest rates, and you're locking in an interest rate for a very, very long period of time. I won't get into the specifics with these, and of course they kind of depend on exactly what fund you're using, but as a general rule, if interest rates were to rise about 1%, many of these funds are likely to fall 15% or more in value. And so you're risking a lot of your savings just to try to get an extra percent or two on your cash. Another popular option today is very low quality corporate bonds. A lot of times these are called junk bonds, and they're bonds issued by companies with relatively poor balance sheets who are at high risk for default. And there's a lot of data about how often these types of companies default. Some of the worst 10-year periods we've seen in the last 40 or 50 years have had default rates as high as 50% for these types of companies. And just last week, there was a record for the lowest yielding junk bond ever issued. It was for Ball Corp, which, if you're a gardener and canned food, you might know they make a lot of the canning jars and canning equipment. Anyway, they are considered a junk company, meaning they're considered very risky to loan money to. And they just offered a bond just under 3% yield. And so that 3% sounds very good today. A lot of people are attracted to it, but it's not a good risk reward payoff if you consider there's a significant chance that you might lose your money if the company defaults. And you can do the math in your head. Even if there's just a 10% chance of losing your money on an investment, you better be getting much higher than a 3% return to make up for that risk. And so don't fall into the trap of piling into a lot of risk on the prospect of hoping just for slightly higher yield on your savings. And so this is all we have prepared for this topic. There is a lot to cover here, a lot of different options. The point we wanted to get across was that, yes, yields are low today, which is not fun. Unfortunately, it's something we have to deal with. And the worst thing to do potentially is to take on a lot of risk with what's supposed to be your savings and a safe asset just to try to get a little bit higher return. We think over time stocks and bonds will continue to produce high returns, and that there's value in having cash even if it has low or even no return. And the last question or an answer that we had prepared today was about mortgage refinance. So we've been hearing a lot about this during the whole year. And even more recently now, people who refinanced a year ago are now maybe able to get rates even lower than what they had then. And so we're starting to see it come around again almost, about people wondering how quickly it can be worth it to refinance your mortgage. And we know a lot of people have taken advantage of this already, and that's good. If things keep going the way they're going, you'll have the opportunity to take advantage of it again very soon. And so we wanted to cover it regardless on kind of where you are and if you've done this already or not. There are some thumb rules out there about when it becomes worth it to refinance. If you can get a 1% difference, it's always worth it, or a 0.5%. You've probably heard some of those things. But there are other items that make an even bigger difference and are just as important as just the difference in interest rates you might be seeing. The first is how long you plan to stay in the home. It also depends how long you've had your current mortgage, and it also depends on where you are in your retirement picture and how long you'll be paying that mortgage into retirement. The first one that gets into how long you'll be in your home is because of closing costs on refinancing. It's expensive. if you guys have done it, you've seen all of the expenses laid out there, and it's not unusual to have $3,000 to $5,000. And now, because there's such demand for refinancing, banks are not kind of giving or cutting any of these fees because there's a million people lined up to refinance. And so right now, even higher costs, 8 to 10,000 is not unheard of. And this is the first big obstacle in refinancing, finding out the break even of that interest rate. If you can get a lower interest rate, what's the payoff where if you have to pay $8,000 or $10,000 in closing costs, you finally see a return. This image down at the bottom is a screenshot from an online calculator I'll link to in a later slide here that we think is really valuable in just kind of showing some basic break even and total savings numbers. And just as a general idea, this is the break even for a $300,000 mortgage, 30-year mortgage with a difference of 0.5% in interest rates with $5,000 in closing costs. And just with that 0.5%, you need about 4 years to kind of break even with the value of that mortgage. And this is really going to depend on the mortgage that you're taking out, the terms of your loan, but between 3 and 5 year break even is what we see common for a lot of people now. And so if you're planning on being out of your house in the next 3 to 5 years, that can be a big red flag to kind of sit back and make sure that this actually makes sense. Another big hurdle is that refinancing has the potential to add a lot of years to your mortgage. You don't have to, of course, but a lot of people are tempted by looking at, a new 30-year mortgage and the much lower monthly rate that it can give you. But that also adds on a lot to your mortgage. You might, if you've been paying on your mortgage for 10 years, you only have 20 years left. Now, if you refinance to a new 30-year, you're going to have 30 years of interest left. And adding on those extra years of interest usually makes it not worth it, even if you can get a lower interest rate. I did an example here of a very high interest mortgage that only had 10 years remaining. I did an 8% mortgage. So this was in 2000. If you took out a mortgage and for some reason had not refinanced, and here you are in 2020 wondering what to do. And even with today's much lower mortgage rates, if you continue to pay off that loan in 10 years, you end up saving money as opposed to refinancing to a new 30-year and having lower interest, but over 30 years. And again, this is just kind of a one-time example. These numbers are going to depend on the value of your mortgage, what you owe still, and the terms on your loan. But just being able to get to a newer or a lower interest rate is not necessarily a green light to go ahead and refinance. If you've been paying on your mortgage for more than just a few years, 5 or 10 years, it can make it tough to break even. And then another topic that we see a lot is people extending their mortgage well into retirement. Again, it's not exactly a bad plan to have a mortgage in retirement. A lot of people, it's in their interest even, but a lot of people, as they're working, are on pace to pay off their mortgage before retirement, and refinancing can now extend those payments into retirement, which creates tax headaches if we were working on you with a Roth conversion plan. If you have to withdraw more from your IRAs and 401ks, that can increase Medicare premiums. It can increase how much your Social Security is taxed, and it can kind of change how you have to withdraw your money in retirement. And so there's a lot of considerations to do where even if you can refinance your mortgage to a lower interest rate, if it causes you to have more expenses later on in retirement, you might have a higher tax bill in retirement, which kind of offsets that lower interest rate, and it might not be worth it. And so as a quick summary here on whether or not you should refinance your mortgage, it's a very personal decision. You have to look at a few different variables. Of course, we're very happy to help you look and compare the pros and cons of doing that. In general, if you look, make sure not to extend your payoff schedule to a much longer term. If you only have 15 years left on your mortgage, look at doing a 15-year refinance instead of a 30-year. And in general, plan to stay in your house for at least a few years. 5 years is probably a little bit on the safer side, but with closing costs, there's definitely a break even that requires at least a couple of years to make sense. If you want to do some research on your own, a good way to start is to compare rates. Any mortgage broker out there is going to be able to shop around and help you out. They'll harass you a lot with, trying to get you to move, but they will be a good resource in making sure you're getting a good rate. And then a lot of finance publications like the Wall Street Journal, which I've showed here, publish all these mortgage rates daily. And so you can make sure that you're getting a rate that's, at least comparable to elsewhere in the country. And then I took a couple of screenshots of that refinance calculator that we use a lot. If you just Google NerdWallet refinance calculator, NerdWallet's a really big financial site now, and they have a couple really neat interactive calculators where you can go and type in your information and see how interest costs would vary, that break-even period, and a couple of good resources like that. So if you're interested, check that out. If you talk to us, we might show you some of these screenshots from this calculator. And so that's what we had for prepared questions for today. Thanks again for joining us. We're happy to answer any questions if you came with anything on your mind. If there's something you'd like us to cover in more detail with slides, in a future webinar, let us know. And if not, have a great rest of your week. Happy Friday, and we'll talk to you later.